So as Paul said, I'm going to talk through what we learned about the public finances yesterday, how that might be different from in November. I'll look quickly at the relatively small impact of the measures that the Chancellor announced yesterday, and also think about the longer-run public finance challenge. So an important backdrop of the public finances over the last decade or so has been the fact that GDP growth has been really weak. So this graph shows GDP per person since the first quarter of 2008. The end of that graph is the first quarter of 2017. That's where we are now. We've grown just 2%. There's just 2% per capita growth over those 9 years. And as Paul said, we normally expect that in one. So if we have a look at what the trend growth would have been if it had just been at about 2% a year, that's actually slightly lower than the long-run trend since the Second World War. And you'll see that there's really a very big gap between where we are and where we might have expected to be before the financial crisis. Now, you may think that sluggish growth over a number of years and a big gap between our current line and that trend line, perhaps that means that there's a lot of room for more growth. There's lots of spare capacity in the economy. Well, not according to the OBR. This graph shows the output gap. That's the difference between the potential level that the economy could achieve and where we currently are today. And you'll see that there is actually no output gap, or in fact the output gap is slightly positive. That's the first time the output gap has been positive since the financial crisis. And that would say, actually, no, there's no more spare capacity. We're not going to get sort of easy economic growth via that. We need real productivity growth to achieve that. Now, this is different from what we thought in November. So, no output gap, the economy is operating at potential. Is this booming Britain? Well, if you look at the public finances, that might not be what you would conclude. So this was the borrowing profile that the Chancellor presented last November, and this was the new one that he presented to us yesterday. The first thing to notice is that towards the end of the forecast, there's really no difference at all. In the longer run, the forecast is basically the same as it was back in March, but there is this large discrepancy at the start of the forecast. So in particular, there's a £16 billion difference in this year's borrowing between the November forecast and March forecast. That's the largest in-year revision that the OBR has made. It's even larger than the revisions that were being made at the time of the financial crisis. However, while there's a large fall this year, that doesn't persist at all throughout the forecast period. Indeed, borrowing is actually set to increase between 2016 and 2017 for the first time since 2012. So what can explain this? How can borrowing be so much lower than forecast this year and yet still be, the forecast for next year still be the same? Well, part of that is explained by classification changes. So there's a change to the way that we incorporate corporation tax revenues, and that accounts for about £3 billion of the difference. But that still leaves that £13 billion difference in 2016-17, but no change in 2017-18. So with this table, I'm now going to take you through the changes that have led to borrowing being lower this year, and yet explain why that doesn't feed through into a stronger forecast overall. So part of the reason why borrowing is set to be so much lower is because tax revenues have been much stronger than expected. Now, this has come from a variety of different revenue sources, for example, income tax and capital gains tax. So that reduces borrowing by about £7.5 billion this year. Not all of that is expected to be permanent. Not all of that leads to borrowing being lower next year, although some of it does. One particular thing to note here is the effects of dividend revenues. So as Paul mentioned, there was a change to dividend taxes announced in the July 2015 budget, and that effectively increased the rate of tax on dividends. Now that encouraged people who pay themselves in dividends to bring dividends forward into a year when the tax rate was lower and then pay themselves less when the tax rate is higher in later years. Now this is called dividend forestalling. Now the OBR did take into account the fact that this forestalling was likely to occur, but they think that they actually underestimated the extent to which it occurred. And so that's good news for borrowing this year. That meant more people reported income that will be taxed this year, but that really is just revenue taken from future years. So actually, while it reduces borrowing this year, it actually increases borrowing by about £2 billion next year. So that's the story on tax. What about spend? We also are set to underspend relative to that November forecast. Well, about $2 billion of that comes from government departments now expected to underspend their budgets by more than the OBR expected. However, we don't think that's going to be a permanent thing. The OBR doesn't expect that underspends are going to be permanently larger in future, so that's just a one-off hit. Then there's another one-off effect from the timing of EU payments. So these are payments of transfers to the European Union. Back in November, the government expected us to make some quite large transfers in the first quarter of this calendar year, which would have meant it would have been registered in the 2016-17 tax year. Those payments are now going to happen later in 2017, and that's good news for borrowing in 2016-17, but there's an equal and opposite bad news on borrowing in 2017-18. This isn't a sort of permanent effect on the public finances. Now, there are also other effects that changed the forecast for borrowing in 2017-18. The profile of economic growth is a bit different. We're expected to grow a bit more strongly in 2017-18, and that's good for the public finances. However, the effect of government decisions in that year, so that decisions that I'm going to talk about a bit more later, leads to borrowing being higher by about £3 billion. And inflation is also higher, and that increases spending, for example, through debt interest payments. So there you can see there are lots of different reasons why borrowing is so low this year, but that's not going to have a permanent effect. A lot of those are just sort of temporary one-off effects for the public finances. So this gives you that picture that I showed you before, that by the end of the forecast period, there's really no difference between what we thought in November and what we now think, or what the OBR now thinks today. However, it is important to put this in perspective. While there's been no forecast change since November, less than a year ago, George Osborne presented the 2016 budget, and you can see that borrowing there was set to fall much more quickly. We were set to have a surplus by 2019-20. And overall, the current forecast implies we'll be borrowing £32 billion more in that year than we were expecting to do just a year ago today. So borrowing falling more slowly than we expected before, but it is still falling. So what's driving that? Well, part of that is the effect of tax and benefit changes, some of which Andy will go into later. But the thing that's really driving this reduction in borrowing is a reduction in departmental spending as a proportion of national income. So I'm now going to look at how that's changed since November. So here you can see real day-to-day spending has fallen quite substantially since 2010, but hasn't really fallen very much since 2012. I told you about those small underspends this year, which means that actually spending this year is slightly lower than we thought it would be back in November. And if we run the forecast forward, there are also a couple of changes. So the government is actually going to spend slightly more in cash terms over the next few years as a result of the measures announced in the budget. And also there are changes to the GDP deflator, the measure of economy-wide inflation. And overall, that means that by the end of the forecast period, we'll be spending more in real terms than we expected we were back in November. So what does this mean about the overall size of the cut between 2016 and 2019? Well, back in the Green Budget last month, we presented the November numbers, which suggested a cut of about £12 billion in real terms. That's been eased slightly in this new forecast. It's only about £7 billion now. Of course, when we're looking at spending, we shouldn't just look at day-to-day spending. We should remember capital spending as well. That's actually increasing quite a lot in real terms over the next few years, by about £16 billion. But that's not changed at all since November. That was true before. It's true now. So those are the large changes that are really driving those changes in borrowing over the forecast period. But as you see, the pictures aren't that different from November. However, the Chancellor did make some changes, and I'm now going to look at the effects of the relatively modest measures that he did make. So this table is going to take you through from this top line, which is what the borrowing forecast would have been if the Chancellor had just stood up and not announced any measures at all, and this bottom line, which is the actual forecast. You'll notice that the numbers aren't that different. He didn't do too much. So firstly, there was an overall tax rise. This was mostly the measures on the self-employed and dividend tax that have already been mentioned. Helen's going to talk about those in more detail in a bit. Notice that these are more backloaded in the forecast to rise, and they're larger beyond 2019-20 than before. So a slight increase in tax, but also a slight increase in spending. And overall spending set to increase by about £3 billion for next year and the year after that. Now, these numbers may look a bit different to the ones on the scorecard. And if you've looked at the scorecards, maybe you're surprised to see it. And that's because not all measures that actually affect the public finances are announced on the scorecard. There are a series of off-scorecard measures. These often tend to be slightly obscure, quite small, and not that interesting. However, I think there's actually one that I at least consider worthy of note today, and that's on the personal injury discount rate. Stick with me. So this is used to determine compensation that covers future losses. So for example, if you have an injury, if you have an accident, that means that you're permanently injured. Now since 2001, that's been set at about 2.5%, but the Lord Chancellor reduced this to minus 0.75% a couple of weeks ago. Now what a lower discount rate means is that when you're making an upfront payment to compensate someone for losses in the future, you have to pay them more. Now, the government is going to consult on options for reform of how and when this discount rate should be set. But I know what you're asking, how does this actually affect the public finances? And I'm glad you asked. So the budget added about 1.2 billion to reserves to cover public sector costs. Now, this is mostly NHS costs, for example, on the payments that they'll have to make on clinical negligence claims. But it doesn't stop there, because a lower discount rate will also mean higher insurance premiums. Now, we have a tax on insurance premiums called insurance premium tax. So that means more tax revenue. But insurance premiums also feature into our measures of inflation. So inflation is going to be higher. And higher inflation means that debt interest payments are going to be higher. So there's really a series of effects that are sort of bumping through all of the public finances. Now, the overall impact is to increase borrowing by about £1.8 billion next year and about £1 billion thereafter. But it's a number of different things going on here. So those are the off-scorecard measures. On the scorecard, there were some measures on social care that Polly's going to talk about after me, and there are also some small measures on education. So we've got a tax rise and a spending rise as well. What does that mean overall? Well, because the spending rises are front-loaded this Parliament, and the tax rises have more in effect later in the forecast, that means it's actually a slight net giveaway over the next couple of years. But this budget really is fiscally neutral in the long run. So that's what we saw yesterday. But what about the bigger picture? The government's fiscal objective is to return the public finances to balance by the end of the next Parliament. So this chart shows public sector net borrowing over the forecast period. Notice that it's hardly falling at all between 2019-20 and 21-22. Now, partly because of this, and also because, as we noted in our green budget, there are lots of demographic pressures that are going to put upward pressure on spending over the next 10 years. The OBR now thinks that the government is not on course to meet its fiscal objective. There's still set to be quite a substantial deficit in 2021, and spending restraint will be ever more difficult when there are more demographic pressures. So let me conclude. The OBR thinks that the economy is running at its productive capacity, and that's despite 9 years of little growth in GDP per head. The reduction in borrowing this year is quite large, but it's just temporary. The prospective real squeeze on day-to-day spending is slightly lower than we thought in November. This budget introduced a modest set of tax and spend measures, but the big picture on the public finances is that that fiscal objective, eliminating the deficit by 2025, is by no means guaranteed. It remains a substantial challenge.